Hello and welcome to my channel. In this video, we will learn about the effects of interest rate changes by the central bank on asset prices such as stocks, bonds, real estate, and commodities. Firstly, we will look at the changes in investor behavior due to changes in interest rates and how that affects the asset prices. Thereafter, we will look at the changes in consumer and business behavior due to changes in interest rates and how that affects the asset prices. The change in interest rate by the central bank, known as the federal fund rate, has a direct impact on the yields and prices of the bonds issued by the US government. The yields on long-term government bonds, such as 10-year treasury bonds, act as a benchmark and are considered risk-free rate. Investors determine their return expectation on all other asset classes based on the prevailing risk-free rate. For example, if the investors are getting 10% return on a long-term government bond, their expectation of returns on stocks would be higher than 10%, given the fact that stocks are riskier than the government bonds. Whereas, if the investors are getting 3% return on a long-term government bond, they might consider a 10% return on stocks to be a relatively good return, which compensates them for their undertaken risk. So, an increase in interest rate by the central bank increases the yields on long-term government bonds, that is, the risk-free rate increases. The increased risk-free rate increases the returns expectation of investors on all other asset classes which are riskier than the government bond. Thus, an increased returns expectation decreases the prices of all other riskier asset classes. Expected returns and prices are inversely correlated because lower prices would result in a higher return in the future. So to summarize, an increase in interest rate decreases the prices for all assets such as real estate, corporate bonds, stocks, and commodities, whereas a decrease in interest rate increases the prices for all the asset classes. Now we look at how interest rates affect consumer and business behavior. When interest rates are lowered, borrowing gets cheaper for the consumers. Thus, consumers borrow money to buy cars or houses and thus increase their spending. Lower interest rates reduce mortgage payments, thus leave more money to spend and invest. Thus, lower interest rate increases sales for the businesses and also increases demand for assets such as real estate, stocks, commodities, and so on. Similarly, for businesses, lower interest rates make borrowing cheaper, and thus businesses borrow money to invest in business expansion. Also, lower interest rates reduce the interest cost and thus improve profit margin. Thus, lowering of interest rate increases the money supply in the economy, which increases economic activity. It also increases asset prices and improves the sales and profits of the businesses in the economy. On the other hand, an increase in interest rate has the opposite effect.